Hi there, I'm Georgia and this is Zan. Today we'll be talking to you about the history of accounting, focusing on the Mercantile period and the Industrial Revolution.
The Mercantile period occurred during the 1500s to around 1750. During this time, worldwide trade developed, and the wealth previously held in Italian cities moved to seagoing countries such as Britain and Holland. During the period, the concept of corporation was developed. However, the relevant legislation at the time prevented the establishment of an incorporation without a royal charter or an act of parliament. Businesses also started being viewed as a going concern, as opposed to a series of individual ventures.
This ongoing business helped develop the concept of dividends. Previously, when a business was viewed as a venture, the profits were split like in a partnership. This didn't suit a going concern, so companies like the East India Company began paying dividends.
As a result of restricted ability to incorporate and the going concern nature of the businesses, the Mercantile period was home to many stock, unincorporated businesses that slowed the development, as it was difficult for shareholders to identify who they were really in business with.
The Industrial Revolution began right after the Mercantile period. As is common knowledge, the Industrial Revolution was a major turning point in history. This was a period of rapid growth and change, both socially and economically. One of the most major business changes was the transition from hand production to machines. This meant industries like textiles and iron production and the use of water and steam for power grew substantially. With all of this growth, the accounting profession changed, especially in the areas of depreciation, capital expenditure, and reporting to shareholders.
During the Industrial Revolution, plenty of assets were purchased at the beginning of a business's life as set up for a venture ahead. It was found that over the years, the assets would slowly lose value and eventually become obsolete. Businesses at the time were able to purchase these assets, capitalise them, and go on to make unreasonable profits, and have a large amount of valuable assets on their balance sheet, and made their business seem more appealing to investors. Because of this, it was decided that there was a need to fairly represent an asset's current value and useful life. Depreciation was brought in as a way to reduce an asset's life over the period of time that it was thought an asset would last. It was brought in by way of expense on the profit and loss statement, and in doing this showed the asset's effective use for that period. The other side of the equation was categorised as accumulated depreciation and was deducted on the balance sheet from the assets to show its fair position of the business. It was essential at the time for depreciation to be brought in, as it was giving an unfair view to the users of financial statements, and as a result could lead to bad investments. There was no official accounting practices at the time unless you were an incorporated company. The idea of incorporating a company became about with the development of the Companies Act put into effect in 1844. Unfortunately, there were no official guidelines on how depreciation was to be calculated or used, which led to people misjudging or misusing the depreciation system, with the railways suffering the most.
During the Industrial Revolution, there was no official or popular accounting system in use. The double-entry bookkeeping system existed, but was not yet common. The old accounting systems did not suit the new environment created by the Industrial Revolution because capital expenditure was not tracked and the figures could not easily be adapted to make statements such as the profit and loss. As the revolution continued, the double-entry bookkeeping system became more popular. This is because it assisted with both the treatment of capital expenditure and reporting to shareholders. Prior to the Industrial Revolution, business operations were highly labour-intensive, so very little capital expenditure was required. This lack of capital expenditure meant that the amounts were very rarely tracked. When more and more machinery was developed during the Industrial Revolution, capital expenditure increased. This created the need for accounting for capital expenditure, and the double-entry bookkeeping method catered to this. Also, with the shift from a labour-intensive industry to an asset-orientated industry, there was a need for change in the way that wages were to be calculated. Products were primarily being produced by machinery, and so the piecebook system that was previously used was no longer relevant. Instead, they developed the hourly rate system, where employees were paid per hour they worked, and also for any additional hours. The double-entry bookkeeping method also catered to the Industrial Revolution through its ability to improve periodic reporting. During the Industrial Revolution, sole traders became less common and business operations occurred through incorporated and unincorporated entities. This meant that there were more shareholders and investors that did not contribute to the day-to-day business operations. As these individuals did not see the day-to-day operations, they did not know how the business was going. This created the need for periodic reporting, and the double entry bookkeeping system allowed for more accurate reporting through the use of general ledgers and collating different account types such as revenues and expenses into separate ledgers to create reports for like the profit and loss.
That was our research on the Mercantile period and the Industrial Revolution. Thank you for listening, and I hope you picked up something.